Hello, everybody. Good morning. Hope you are doing good. Hello, friends. So this one is a quick video on trying to use order flow information more effectively and efficiently. Okay, so I'm going to share some quick tips on how to use order flow information in a very easy and efficient manner. Especially this is for somebody who's getting started with order flow data, and especially this is with somebody who's getting started with order flow data, and is new to order flow. He or she probably has existing methods already in terms of what you are using. There are certain strategies, setups that you're already using, and you want to add the order flow data or order flow studies to your trading strategy model, etc., observation, whatever you call it. And how do you get started with it efficiently? Because a lot of people, over time I've heard, and a lot of feedbacks I've received is sometimes for somebody who's just starting off, just tracking the footprint information, etc., is a very overwhelming in terms of understanding the footprint data and the footprint information. So they want to probably look at an easier way of doing it and tracking it. Okay, so what we will want to cover is only two sets of indicators here, nothing else. We have price and volume, of course. Okay, this is the volume profile chart that you see on top. This is the volume profile chart, and then we are using something called as the delta bars, and we are using it in a cumulative mode. So you'll get the delta bars in the indicator option. So you can go to your studies indicators, you have something called as delta bar, and we are using it in the cumulative mode. Okay, so we are only focusing on price, and we are only focusing on the cumulative delta bars. That's it. Okay, so I'll share two rules. Okay, and again, to make this very simple, I'll just share two rules around price and delta bar. Rule number one is essentially, um, let's say, so what is cumulative delta? First of all, just quickly before I even share the rule, actually, cumulative delta is the delta, sum of the delta for the entire session as the session progresses. Okay, so every session, at the start of the session, it will start at zero. It has no hangover from the previous day data, so there is nothing that you carry over from previous day data. Every session at 9:15 or whenever your markets are starting, okay, this will essentially have your this will essentially have your it will start at zero, and it will keep on adding the delta of each bar subsequently. So if the for example, if the first bar has a delta of 50, and then the next bar has a delta of 100, then the third bar, let's say, has a delta of minus 25, and then let's say the fourth bar has a delta of 200. So what cumulative will do, it will just keep on adding it to the previous one. So this will be 50, and then 50 plus 100, this will be 150. 150 minus 25, this will be 125. Okay, and then 125 and plus 200, this will be 325. So the cumulative delta will keep on, I'm struggling to type here, but you understand the cumulative delta will keep on adding the delta from the previous delta values. Okay, so that's cumulative delta. Now we'll just talk about two simple rules. Rule number one is essentially, try to stay on the side of the cumulative delta. Okay, so try to stay on the side of the cumulative delta, which essentially means if the cumulative delta is positive, we will look to stay positive. We'll look for pullback longs. We will not look for short trades. That is the fundamental, play. Okay, so it is listed barnacles. You know where blistering barnacles is coming from, right? So rule number one is essentially saying that, okay, just a second. Okay, so rule number one, so look to trade in the direction of the overall CVD, especially if the price movements are in sync. So CVD is positive, look for pullback play longs and don't look for shorts. Okay, and similarly, if the CVD of the day is negative, whenever you're watching it, look for sort of longs and not shorts. Okay, shorts and not long. So we'll take a few examples, and before that, so for example, we'll take any random day. Let's go back here. Let's take this day, which started kind of flattish from previous day. I'm not taking any specific examples. This is again 16th of May, some random day. So if you see the CVD of this day, it started at zero again. As I said, it started at zero here, while the initial candle was flat, and it opened kind of bullish, but the CVD started at zero. But at some point, the CVD was failing to go above zero line any time of time. This is the zero line of the CVD. right? This is the zero line. So and eventually drifted negative, right? So what happens is it drifted negative. So as when I see the CVD at any point of the day, let's say I'm coming in the market here and I'm seeing CVD is negative, what I'll do is I'll look for pullback shots. So any pullback shots that I get, I'll try to short the market, and eventually this market closed at the low of the day. Similarly, here it was trend day down, but if you see it opened gap up, right? It opened gap up. So it's very difficult at this point to figure out whether it's trended down or not. But here, if you see, despite this pullback here, the CVD was well down. Okay, in this space, if you see the price did pull back, but the CVD straight down. So what my theory will say that okay, since the CVD is not turning to positive, I look for pullback short. So when the pullback happened, we go short, and we'll it eventually fell as well. This one on the contrary started negative, okay, in the CVD space, but eventually pulled back and the CVD was positive all through the day, okay. And what has happened is in this case, uh, you know, market did pull back. So any pullback that we get a long play, and then eventually you see CVD started turning very negative here, and the price is also negative. But still, the CVD overall stayed kind of positive throughout the day, and then eventually there were pullback opportunities there. So idea is you of course have to combine it with other things, but the odds increases if I'm staying on the side of the CVD. Okay. Now, rule number two, which is essentially, is it always a thumb rule? No. There are times when you want to look for reversal trades. So in rule number two, what we are doing is when there's a massive change in delta over one or two candles, when there is one or two candles with big delta and kind of engulfing price candles, okay, as well, then I'm looking to reverse the direction. Then I'm looking to say that okay, market has a serious change of context with buyers or sellers coming in, and I'm looking to change the context. So what we'll do is in this case, if the CVD is positive, we have a one large candle with huge delta coming in, okay, we will try to then say that okay, now this is a change in the market structure, and we will want to now kind of look for shorts, okay. So my rule number two is this, okay, which is essentially saying that okay, if there is a if when massive change in over one or two delta when massive change in delta over one or two candles are seen with strong price engulfing, look to reverse the direction. Example, if CVD is positive, we have one large candle where red candle the delta that is greater than usually 20% or more of the entire day's delta, then we are looking to sort of reverse the trade. Okay, let's see if we have certain situations here and there or not. Okay, this one, if you see this candle, right, and the CVD started as positive, 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 and then we had this strong engulfing red candle, and then and after that it with a good CVD end price, and after that the prices hardly took off, and we were not able to trade off. Okay, similarly in this one, next day, if you see the CVD started red, market was going short. Okay, so till this point, I think every pullback was a short opportunity, because despite this pullback, market again went short, right? Then we had this delta, which was a massive delta change. If you compare it to all the subsequent candles here, which was kind of this candle, okay. And once we had this candle, market kind of boomeranged back, and if you see, and then there was a long play on again here there was a change in delta where there was a shift in CVD just went to around zero. And notice another thing, while price pulled back to higher highs, CVD just pulled back to zero here, and then again we have a red CVD, which is a delta shift, major delta shift, and we had prices again going down all the way. Okay, we will take maybe one or two examples more just to see. I don't know, I'm looking at a good example to showcase it to you. So this one again is a good change in delta. Prices started oscillating downwards. Okay. Then again, if you see here, this candle was a good massive change in delta, okay, from compared to the overall context of the price. And after that, there was again, because delta was negative, CVD was negative, so short trade was one. But rule two kicked in here, where we said okay, there's a good change in delta and a good change in price, and then again we are going for pullback longs after this game. Okay, so only two rules, guys. Only two rules to follow. One, try to stay on the side of the overall CVD. Rule number two, okay, just a second. Rule number two, If the CVD is kind of engulfing with a 20% or more change in a single bar, if the delta is changing, then look for reversal of the trades. Okay, try to follow this and put it along with your core strategies that you have, and it's one of the easiest and the most efficient way of following order flow in the day. I don't have to look at the footprints here. I'm just looking at price and the CVD of the day. Okay, hope this helps. Thank you so much. Thank you for staying on. Thank you.